Markets are near highs, IPO activity is picking up, and optimism is building. But is this where real opportunity begins or where investors get distracted? Hi, I'm Eric Pettway, Chief Investment Officer at Journey Advisor Group. Welcome to CIO Corner. Let's start with a quick market update. Last week, markets moved higher again. The S&P 500 gained 0.3%, while the Nasdaq 100 rose 1.1%. We're still just off all-time highs, and the S&P is now up 9.1% for the year. International markets continue to outperform in 2026, staying ahead of U.S. equities year to date. Energy prices are also starting to ease. Oil and gas have come down from recent highs, and a deal has been announced that would reopen key global shipping routes. That's something markets are watching closely because of its impact on inflation and overall costs. Last week also brought SpaceX's successful public market debut on Friday. The IPO was the largest in history, with shares closing 19% higher on the first day. Markets are also looking for potential major IPOs from Anthropic and OpenAI in the second half of 2026. Earnings continue to deliver for 2026, and according to FactSet, the estimated year-over-year earnings growth rate for the S&P 500 is 21.9%. If confirmed, this would mark the second straight quarter of earnings growth above 20% for the index. So what does all of this actually mean for investors? Here's the key point. When IPOs and big market headlines dominate the conversation, it often reflects a broader environment of confidence. Companies tend to go public when conditions are favorable and demand is strong. That can be a positive signal for markets overall, but there are some important nuances. Companies today are staying private longer than they did in the past. By the time they go public, valuations are often already elevated. That changes the opportunity set compared to earlier cycles. It's also easy to focus on the first few days of trading. Big headlines, big moves, but historically, long-term results have mattered far more than short-term performance. The companies that contribute meaningfully to portfolios tend to do so over years, not days. Another factor to keep in mind is how these success stories are framed. You often hear about early investors who achieve significant gains. What's less visible are the many investments that didn't work out. That's simply part of that investment model. For most investors, maintaining a diversified portfolio aligned with long-term goals remains the focus. And when we step back and look at the broader market, valuations in certain sectors remain above long-term averages. For example, technology continues to trade at elevated levels relative to history. That doesn't mean avoiding growth areas, but it does reinforce the importance of balancing opportunity with risk management. Now it's time for a chart of the week. If you look at the long-term performance of public technology stocks, the trend has been strong, but not without periods of volatility. There have been meaningful pullbacks along the way. That's the big takeaway. New IPOs and innovation can create opportunity, and they often reflect positive market conditions. But staying disciplined and focused on long-term objectives is what has historically driven investor outcomes. Thanks for spending a few minutes with us today. If you find this content helpful, follow us on LinkedIn or your preferred platform. And if you have questions about your portfolio or want to revisit your strategy, connect with your Journey Advisor Group team. As always, remain calm, stay focused, and most importantly, stay the course.